Hello, friends. This is Rajat Dar, Director Investments at Indian Federation for Investors and Global Traders, and where we talk about Indian policy rates, global macroeconomic scenarios, client portfolios, and how that should be structured in lines with the changing trends, whether they are micro or macro. So, in line to the same and bringing it highly quantified action oriented podcast for our members and investors community. I today am honored to have Mr. Sridhar Shivaram, who is actually the Director of Investments at Enam Holdings. Welcome, sir.
Thank you
For
very
to-
much for inviting me.
And like we say, the money man, but before being a money man, he has been the total finance guy, has been a chartered accountant by education, company secretary, and then also cost accountant. Not only that, he started his uh, work experience from Citibank. So we do have a man here with great reputation that actually precedes him. And after being at Citibank, had been with Morgan Stanley and been a part of emerging markets and has been managing that over the years from 1994 to 2015. And after that has been heading as a director of investments with Enam Holdings. So, sir, before we set the tone for it, what has changed when you were at Morgan Stanley and currently when you're doing at Enam? So, what has changed in Indian economy per se?
Well, I think not much has changed because, even when I was learning investing in 1994, I learned very early from my bosses that, India is not an isolated market. We are interlinked with a lot of other markets. And I think it was in 1996 that we had the Asian crisis, which was very serious in the other emerging markets like Indonesia, Thailand, and all. It had an impact on our Indian market. So if you remember, between 94 and 2003, our markets never gave any returns, barring the tech boom bust. So again, we had the tech boom in 1999 to about 2001. It was again a replica of what happened in the US markets. And those who remember those days used to every day look at what happened to NASDAQ the previous night, and our markets used to replicate that immediately. So I think we've been a very interlinked market. Global macros have played a large role. And fortunately, I started very early in MNCs, which gave me the baptism of how global macro behaves. And that has helped. So even today, if you see, we look at what has happened to tariffs, what happened to China, what is happening to, say, international geopolitical situation, what is happening to oil. All of this has an impact on our Indian markets, whether we like it or not. It does have an impact. So I don't think much has changed. Even in Enam, we look at global macro, we look at how things play out, and that's how we invest.
And the best part of it is even from the investor behavior, nothing has changed. The same errors that investors used to do 10 years prior, again today the same thing is happening. Many people who had invested a year back had cashed out of it. So coming on to this part, because the other day when we were having a telecon and in a conversation, you rightly put a perspective, okay, Rajat, while inflation is too low and coming lower, it is clearly a pain point when we look at Indian economy from a growth perspective. And you cited some of the global examples. So I would like you to put more light on inflation numbers being low today and put a perspective where, because if we want to, like, government wants to push manufacturing as an example. So therefore, when you look at inflation and when you look at India, we need to make some comparisons to the global peers. And you already being from the international firm, starting your career with Morgan Stanley, I think you should take a lead on how inflation in India currently is and how it is compared to global peers and what should be there for investors to look forward to.
Yeah, so I think RBI and the government, post the new regime, which is post 2014, has been focusing a lot on inflation. And I think it is right. I mean, I'm not at this stage criticizing that, having a control on inflation is not bad. But an over focus on inflation, which is what we have landed ourselves in now, where we are literally having zero WPI inflation, maybe if you take the last 2-3 years. And our CPI also is at an all-time low. In fact, I'm expecting that for the current month, which is October of also the previous month, which is the October of 2025, our inflation will be the lowest ever. It will be closer to 0.5%.
Yes.
We have never seen such low inflation. So what happens is that Nominal GDP makes a difference because the government looks at nominal GDP for their fiscal deficit. For even for companies, nominal GDP makes a difference because their revenues depend on the nominal GDP. So if you have some inflation, your volume growth into inflation, and then that's how the sales value comes. So, and based on that, profitability comes. When you have very low nominal GDP, and that's what we are seeing currently, you can see that in the corporate numbers, that on an aggregate basis, our corporate profitability has been very low. In fact, for
Yes.
the last 18 months, our corporate profitability has been struggling. So that's been one of my points, that a very low nominal GDP, very over focus on inflation can also be very bad, because we are at what, 2,500, 3,000 per capita. We are not a developed nation. We are a developing nation.
True.
And there is a need for some bit of inflation in the economy. In my view, a fair inflation is between 4 and 6, though RBI has set a target which is closer to 4. My view is that it should be between 4 and 6. And there is a debate currently going on where RBI has asked for feedback on the next 5 years. What should be the inflation targeting policy? I have given a feedback that it should be between 4 and 6 and not around 4.
Okay.
In this context, I would want to share, some of the data from other emerging markets. So if you see Korea, for instance, Korea was one of the Asian tigers. In between 1966 and 1985, they had like almost 20 years of, boom. And they had almost 13% inflation during that period. And
Yes.
as you can see
Yes.
in the chart, that we also calculated what is the peer group inflation, because some people mentioned that, there was an oil crisis, so you cannot just look at inflation in isolation. So we looked at the peer group, which is countries in and around Korea. And we
True.
found that only Korea had hyperinflation, but they also had hyper growth. We then checked as to what happened to, say, China, and we saw the same even for China. I'll just that's the China growth number. So if you see between 1992 and 2001, they had a dream period of growth of almost 10% GDP for almost 2 decades. And if you see, the average inflation for them also has been in the range of 7%. And if you look at the peer group numbers, they've been very reasonable. The point I'm making is that when you have hyper growth, it does come with some bit of inflation. I'm not for a moment suggesting double-digit inflation is what we should look at, but an hyper focus on inflation results in subpar. That's the point I'm trying to make.
Okay. So, taking this, so I am, when we look at this, we are looking at nearly 4 different aspects for that matter. Say, for example, growth versus inflation trade-off. Okay. And we have seen here ki, in case of Korea and China, 30% of their GDP contribution was from manufacturing. And obviously that might also be a perspective of their inflation being higher. But the way they have sustained their growth and really optimized and took the most benefit of that opportunity when it came and made the most of it. So therefore, it comes to a very crucial question, and on this I want your inputs. Are we overemphasizing the risk of inflation when historically countries grew faster actually because of it? Are we overemphasizing, and how should investors then look at it?
No, I think, see, some bit of focus on inflation is good. So if you go back to when India was deemed as fragile 5, I think that was in 2012 and 13.
Yes.
Our problem was we had double-digit inflation, but we not only had double-digit inflation, our fiscal deficit was very high, and also our current account deficits were very high. We had number of macro challenges at that point of time. At current, if you see, lot of the macro factors are in our favor right now. So my point is that between Reserve Bank and government, there should be some sort of a view on what is a fair inflation. Do you really want 1 and 2% inflation? Or do you think for a growing economy like ours, 4 to 6% inflation is a reasonable number? That is a debate which is going on. As I said, my view is that 4 to 6% is a reasonable number. That's what we should be targeting. That helps a slightly higher nominal GDP and also helps lower rates from a policy standpoint. That today,
Okay.
if you see, as soon as the inflation comes closer to 4, Reserve Bank is in fact, as we speak, Reserve Bank already has, changed their stance and has made it as a neutral stance. I mean, we
Yes.
are going to we have a neutral stance at a time when we are hitting all-time low inflation. So I find that as a dichotomy, that you should
True.
have been in an accommodative stance at this stage.
Yes.
But that's
Yes.
because they view that in the future it will hit 4. So we have to, make a change in stance much before ahead of the numbers. That's the point I'm making.
So when we now come to the various initiatives that government has taken, and if I may ask you, is this really India's moment? That means,
Yeah,
is
yeah.
India at the same stage what Korea and China were at, like you showed it? What it is, like your inputs on it?
So I don't have a crystal ball to gaze that far, and I'm not very sure whether globally it's possible for any country to grow that fast for 20
Hmm.
years. But having said that, I do think that the government and Reserve Bank, is my view based on my discussions with various people in Delhi and people who understand inflation. There has been a change in stance by the government and Reserve Bank. They do understand that a very low nominal GDP is hurting the growth. Keep in mind that the GDP numbers that we are seeing, which is 7.8, we may see another 7 plus print for the Q2 number.
Yes.
There is a statistical anomaly here because the GDP deflator is used here, and the GDP deflator 60% is WPI. And if your WPI is 1%, your adjustment factor is very low. So what we focus more is on the nominal GDP right now. And if you see the nominal GDP growth is 1%. In the budget, the government is expecting 11 to 12% growth in nominal GDP. That is the crux of the point. I think there has been a change in stance, at least if you look at all the policy initiatives that we have seen in the say last 6 months. One is the rate cut that we've seen, increased liquidity by Reserve Bank. Then we saw the GST cuts. So
Yes.
government also wants more consumption because earlier they were focused more on investment. It looks like there is a change in stance where they want more consumption, because as you get more consumption, that automatically results in demand, which will result in investments.
Exactly.
So I think, in my view, there is a change of stance, which is the government and Reserve Bank do want slightly higher nominal GDP. Based on this expectation, I am expecting that we will see rate cut of 25 to 50 basis points over the next two monetary policy meetings.
Cycles. Okay.
That's my broad view. I mean, obviously, I have no insights on this, but based on the numbers, this is my expectation.
So, like we can see that we are currently in a very transition quarter. This is a transition quarter because our festivities are behind our back, and now the budget is just at the doorstep. So, when you look at this period, and we have also seen in certain sectors the growth still being tapered down, market commentators stating that India is still overvalued, overpriced, and when you look at budget and you look at where we are currently at the crossroads, what do you think are market sentiments? Firstly, from capital markets point of view, and from the economic growth perspective, where you are looking at, because many a times we will say, okay, whatever the government has done right now, say whether that was GST cuts and all, in anticipation of what is expected of the budget, like you have already said about the rate cut scenario that we can see over the next two cycles. But when budget is coming up, how do you see the budget impacting the broader economy as well as capital market?
So first on the capital markets, I think in the last 18 months, we've seen our markets hardly do anything. We've been one of the big underperformers. In fact, in my last 25 years of tracking emerging markets, I've never seen India underperform so much. In fact, 2025 has been a blockbuster year for emerging markets. Emerging markets on an aggregate is up 30%. Almost every large market is up 40 to 50%. I mean, large market like Korea is up, say, 50, 60%. Taiwan is up 30%. The entire Latin American markets, from Brazil to Mexico, all of them are up 30, 35%. So this has been a very rare event where emerging markets on an aggregate has done so well. And India has been a massive laggard in this. And one of the reasons is that our poor earnings growth. So people keep talking about valuations being high, but India always had higher valuations because India had growth. So we used to get 15 to 18% growth on an aggregate. And within that, we used to have large components growing at even higher than 20%. And the companies which grew at higher than 20% had a higher valuation. Unfortunately, what we've had is last 18 months, we faced very low growth. And in my view, it comes from the low nominal GDP that we've seen, where WPI is literally zero. CPI is now heading to its all-time low ever. And all these factors combined have led to a poor earnings growth. In our view, this is changing now. So the next year, which is say 25, 26, 27 financial year, we think that the market aggregate earnings growth will be north of 15%.
Okay.
So we will come back to our growth path, which is what our the trademark for India was high growth companies. We are going to get into that growth phase from next year. One, thanks to the low base effect. Two, also because of all the policy initiatives from the central bank and from the government.
Okay.
We will see earnings growth come back, and that will result in a stronger market growth from next year. That's my broad view. As I said, it's very difficult to predict markets, but when I look at the data points, it is suggesting to me that we are poised very well.
From the budget, what are you anticipating that government will unravel in this budget? Like last time they did for real estate.
My personal view is that the government has been over focused on fiscal deficit. Our target is 4.4 for the current year, and I think they will meet the target despite what they've done with GST cuts, which has an impact on the revenue that their government will generate. I think it will come at the expense of capital expenditure, is my view. That they will spend lesser on capital expenditure because finally there's a finite pool of money. And if you're going to lose out because of GST, then you have to compensate that from some other pool. So my view is that they will do lesser capex, and the same can happen with a lot of the state governments also, because they also are party to the GST cut.
Yes.
And they will also reduce their capex spend, is my view, because they have to manage their budget from some other positions.
So, yeah, please.
So that, in my view, isn't very good. So if you ask me what is my wish list for the budget next year, is that let the government keep a status quo on fiscal deficit. Let it be closer to where it is, which is 4.4%, or even maybe a 10 basis points increase in fiscal deficit, which increases the growth potential for the country. So along with the fiscal stimulus, if the government can give, which they have already given to some extent from the GST cuts, and the monetary stimulus which central bank can give because of the low inflation, these the combination of these two will boost growth. So I'm not getting into nitty-gritties of what I'm expecting from taxation for individuals or capital gains or any of those. If I see a broad number of fiscal deficit number, which is not I'm just hoping that they don't take it to 4%. They've been reducing the fiscal deficit by about 20 to 40 basis points every budget. I'm just hoping that they just take a pause for a year, which will be good for growth.
Great. So, like you mentioned a point like capex, like obviously the government of India and state governments will also be cutting down on their capex, and also budget coming up. These 2-3 months will be like that. But over the next 12 months, how are you seeing private players? Would private capex go up? So, from a private player capex expansion, how do you see it opening up over the next 1 year?
So contrary to popular belief that private capex has been slow, actually the previous year itself, the private capex crossed the government capex. So if you see the aggregate capex that private companies had spent last year, which is the March of 24-25, the private capex total number aggregated to around 11 lakh crores. And the government capex for the previous year was around 10.5 lakh crores. So the private capex had already crossed the government capex. We are expecting for the current year, which is 25-26, the private capex number to be closer to 12 to 13 lakh crores. Again, it will be much higher than what the government is. Why people say that the private capex hasn't picked up is because as a percentage of GDP, if you go back to the heydays of 2007 or 2011-12, these numbers were far higher as a percentage of GDP. So that is one of the reasons. But we think along with the changes that the government has done, which is the GST cut, we will see increased demand coming up. So as a result of the increased demand, we'll have capex anyway coming up. So we do expect private capex to, meaningfully pick up over the next 2-3 years.
You have rightly said over the next 1 year, like 2026, we can see markets again stabilizing, growing, going for a high growth part. Now, over the past 1 year or before the rate cut cycle started, and now the rate cut cycle is already there. We are also seeing US also cutting the rate of interest. How should an investor who is invested, say 60-20-20 in equity, debt and alternates, how he could look and structure his portfolio? How he should look to structure his long-term portfolio, say 10 years? What should be the guiding spirit rather than just, chasing the returns or chasing the numbers? So if he's seeing how the policy changes are going, how the rate of interest is going, how he should tweak his normal portfolio?
So I think, see, because India is a growing market, our per capita GDP is so low. I mean, the general view, and that's my view also, is that a large portion of your portfolio should be in equities. I mean, there is no debate that we've had a lull in our equity returns over the last 18 months. But there are pauses. If you go back and see in the last 20 years, no market is linear. So there are points of time when it doesn't give any return, but over a period it makes up. And on a longer term basis, we do end up with, say, between 12 and 15% compounded returns in the market. So I have no debate that if I take this forward for the next 5 years, we would have similar returns. But
Perfect.
it is not linear. It's not going to be every year. So I would still suggest that a large part should be in equity. I'm also a proponent of gold. So my view is that at least 10% of your portfolio should be in gold because of two reasons. One, as a rupee investor, gold is a store of value. And what people forget is it's also a hedge against the currency. The currency has given us, if you take the last 10 years, about 3%, and if you expand that back to about 20 or 30 years, the currency returns itself have been 4 to 5%.
Okay.
So, and I don't see that changing. Even if you see, even for the current year, our currency is already depreciated by about 2.5%. So, my broad view is that given where we are from a geopolitical standpoint, given how the central bank balance sheets have bloated across the globe,
Hmm.
I think gold as a store of value will continue to find interest. Central banks themselves are buying, almost 1,000 tons of gold every year. I don't see that changing in a hurry. Obviously, gold is up 50%. You can't expect 50% return every year. So there will be some normalization. There will be some correction. I think the irrational exuberance currently is very high on both on gold and silver. And I think that will die down over a period of time because a lot of the people who have missed the rally are now jumping in. But over a period, I still would suggest that gold to a large extent and maybe to a much smaller extent, silver should be about 10%.
Perfect.
And the rest is alternate. I mean, I'm not an expert on real estate, so I really can't comment. But debt is something that people should look at. I mean, there are various options as far as debt is concerned. Even though our interest rates are falling, the debt returns have really not fallen that drastically. So if you see
Exactly.
the 10-year bond yields roughly there where it was even before the 50 basis point rate cut. So, I'm not an expert on this market, but I do believe that 20% in debt is a fair number, and the rest can be allocated to equities.
Perfect, perfect, perfect. Sir, the other day when we were having a conversation, we were having key rate of interest is going down and markets will open up. Private capex is also high. That brings us to a question within equity that yes, there are sectors which obviously will be benefiting. Markets, there are many sectors which are also cyclical. So, for example, we are looking at consumption as a story, like you rightly quoted the other day, and manufacturing and financial. Under the light of these information and the rate cut scenario we are looking at, how things will pan out normally whenever these things happen, rate cut scenario, global macroeconomics, how does consumption, manufacturing and financial, how do these three sectors react so that investor is obviously able to understand what his portfolio is expected to give. If they are investing in thematic, for example, they are highly into thematic, but they don't know how cyclical factors can impact,
Yeah.
So the problem is, if manufacturing had given, say, 30% return last year, the returns are already made. They now get into it, seeing the returns. Now the rate cycle changes, and now they're into the falling rate scenario. So the falling performance scenario. So in light of this, consumption, manufacturing, financial, how you look at it, and what investors should know while they are focusing on these.
So my general view is that investors should avoid thematic funds unless you're an expert. So that's my first overarching, because the very fact that it's a thematic fund has a cycle and the themes don't last forever. And when you invest in a diversified fund, the fund manager is smart enough to figure out what is the theme of that time. And as the cycle turns, he will move to a different cycle. But if you as an investor get stuck in a thematic fund and you're not so savvy enough, you may get stuck with that theme even after the
Yeah.
theme has, faded away. That's my
Yes.
first basic. But more broadly, I think all these three should do well. A financial should do well. Maybe in the initial phase of rate cut, banks may not do that well because they have an impact on their asset side, because as the rates go down, they have to pass on the rate benefit to the customer.
Yes.
And the liability transition happens with a lag. But a large part of the rate cut is already done. So I think from next year onwards, given the base effect also, banks should also do well. NBFC should do well. And within the financial space, we also like the entire capital markets play because we are very early in the capital markets in terms of the growth. We are seeing, newer investors coming in. So the entire capital markets look very interesting. Again, it's a cycle because, markets don't go up every year. But if you take, say, a 3 or 5 year period, the capital markets as a cycle should do well. We're also bullish on manufacturing because we think the government is giving a lot of incentives for companies to manufacture, PLI schemes, rate cuts, GST reduction, and also as demand comes back, companies will put capex. I mean, one of the main things for capex not coming is demand. If there is demand, every private entrepreneur is smart enough to know if there is demand, he'll put up capex. So we think that as demand comes back, we'll see the capex also coming. Also, India is becoming very integrated within the global value chain, as we are seeing with Apple and many of the others in the electronics manufacturing. India will become a key player in the global value chain. So we think over the next few years, capex will come back and manufacturing should do well. And consumption, we've already spoken that given the GST cuts, these should boost consumption, and also lower interest rates help lower loan rates for consumers, and that helps them to consume more. So if I look at on a broad basis, the three wheels which are very important for the capital markets, all three should do well, which is one of the reasons why I mentioned that we could see closer to 15% earnings growth for the next year.
Because US currency is still strong. If US cuts the rate or doesn't cut the rate. So there are two things we are looking at. If any of these scenario, how Indian markets will impact, point number one. Point number two, because we have already seen Taiwan and Korean market going up. Is that market still overpriced so that we can see money coming out of that market and then getting diverted to India in the near future? Can we look at that scenario and what impact could be on the Indian markets for that matter?
So if you ask me, the biggest threat to Indian market is what happens in the US. Because US, if you see today, their fiscal deficit is very unsustainable. They are almost at 7%, 6.5%, 7% fiscal deficit. Their debt to GDP is almost 250, 300%.
Yes.
So if there is any crisis in the US, like what we saw in 2008, then there is no hiding place. If you ask me, what is the biggest risk to the market? Biggest risk is what happens to the US markets if there is any accident. Base case is not that there will be an accident, but that is something that one has to keep a close watch on.
Okay.
Also keep in mind that US is now 70% of the global indices in terms of percentage. So they are 20-25% of the GDP, but they're 70% of the global market cap. So a very large portion of the capital goes to the US because they're such dominant players. I mean, just to put thing in context, that Nvidia, the market cap of Nvidia is closer to the market cap of the entire Indian market. And that's just one company. So that is the scale that we are talking of. And any accidents there, I don't see any global market escaping that. But the positive from that is that if that be the case, eventually the percentage of US as a percentage of global market cap will come down. As it comes down, other markets will benefit. And one of the market to benefit should be India. So that's how I'll put it, that if any of this happens, over a period, we will see India benefit. But if there is a crisis, then it will be foolish to expect that, India is isolated, we are a domestic market and we will escape it. It doesn't work that way. But we've seen many crises in the past. They have come and gone, and our markets continue to give reasonable return. So expecting the crisis is not the base case scenario.
You're rightly quoted, because even if we see in the recent past, over the last 1.5 year, many of the platforms have come up that even entice many of the retail investors to invest overseas, because they have been seeing, okay, what are the returns have been in the US market and all, and they are now using various online platforms to earlier that used to be much of a cryptocurrency, but now say US markets, and without actually understanding the aspects, because you have rightly said they are just one accident away from the knockdown, and but this is a very crucial aspect, because many of the investors just do not know that 70% of US
global market cap.
Market cap US is holding, when only 25% is the contribution to the GDP. That's really good. So when we now talk about emerging market, and if I'm not wrong, please correct me, sir, like India has I believe 18 to 20% of the play into the emerging market space.
Yeah, the weight-wise, yes.
Yes. So are we a defensive emerging market play, or there is still a beta play involved for India to be in the emerging market space?
So within the emerging markets, we are in the top three. China is the largest weight. And between Taiwan and India, the weight keeps moving up and down. So Taiwan has done very well this year and India hasn't done well. See, Taiwan is also an AI player because some of the largest chips are manufactured in Taiwan. So there
True.
is a craze right now for chips for AI. And as a result, the large companies in Taiwan are benefiting. So this year, Taiwan has done very well. So their weight has gone up ahead of India. And as I mentioned earlier, that India generally has a strong growth. And we've seen that over the last 12 to 18 months, our growth has tapered down. So as our growth comes back, that is my expectation that as our growth comes back next year, we would see increased allocation from foreign institutional investors to India. But having said all this, I just want to put a caveat that emerging market as an asset class hasn't given returns for 20 because they keep having accidents every year from one country to another. So if you take the dollar return for the last 20 years or last 10 years, emerging market returns are in the 1 to 2% dollar return.
Wow.
So as an asset class, it has been very poor. So we continue to see, and the other asset class which has done well, which we already discussed, is US. So the US markets have given 12, 13% dollar returns to investors. So as a result, money keeps moving away from emerging markets into developed markets, and especially US markets. So until and unless emerging market as an asset class starts to give consistent return, like this year they have given 30% return after a very long period of time, unless this is a consistent pattern, we don't see this asset class, coming back in a hurry.
So what worries you about the investor behavior right now, and what behavioral traps can investor should watch out for himself?
No, I think one is, the fear of missing out, greed and fear. I mean, these are psychological terms that we say, but the best advice is to allow your portfolio to stay invested and give it good time. You know, the returns come over time. It's not timing the market. It is time spent in the market which gives you the return. So my view is that as long as you follow a reasonably decent asset allocation, as I said, at least 10% in gold, 60 to 70% in equity, and the balance you can figure out, where you want to invest, and you allow this to, compound over a period of time, and that's how returns come. The power of compounding is phenomenal. But if we keep switching, churning, and keep moving from one person to another, then you end up losing on the returns. And the other thing is this need for instant gratification, that you want to invest today and you want the stock to double tomorrow. It doesn't happen. You invariably will buy based on somebody's tip, and then you will lose money. So I think that there's no instant gratification in the market. This is a long haul. It's a marathon that you play for that. It's not a T20.
Exactly, we're seeing EV play and all. So is this a real investment theme, or still it is too early for Indian markets when we talk about renewables, EV battery and all those things?
I think it's too early because India doesn't control any of the value chain here. The entire value chain is controlled by China, especially be it on EVs, be it on solar, excepting for wind where India manufactures, a large portion. In most other cases, the value chain is controlled by China. So if you're investing in any of these thematic plays today, you have to be very clear what is happening in China, because there is excess capacity in China. And if there is any change in policy, we could see very cheap Chinese stuff coming into India. And just keep in mind that it doesn't mean China means quality is bad. You know, they also make good quality stuff. So you have to just keep in mind that we have no right to win in any of this because we have not invested. So today, if you take EV, the EV battery, rare earth, almost everything comes from China, and they have the best manufacturing capability. So I'll be very wary of this. But yeah, this is a trend which will surely happen. Whether it will benefit any manufacturing or listed company, I'm not very sure.
Okay, great. So now this also brings us to the last, but one more thing about digital India. We are talking about fintech apps, we're talking about UPI and all those things. Is it still investable, or is it overhyped when we talk about digital fintech?
Yeah, so digital fintech, if you add even the Zomato, Swiggy's, and many of the other, which is the platform apps here. some of them are investable. So I cannot say that they are not investable, but you have to look for a path to profitability that these companies have. And if you think that there is a path to profitability, then these are worth investing. On the UPI side, you have to be very careful because there is very little money to be made because UPI is a free app and the government does subsidize to some extent. I don't see that free nature of the app changing, but companies have found ways to make money through lending to merchants and stuff like that, where there is some money to be made. It's an interesting space. It's a very stock specific, I would say, approach. It's not a general approach that you buy all the stocks that are there.
So now the closing question is, जो मैंने climax के लिए रखा था, what do you think of, like, these 2 days Lenskart IPO is the hot cake of discussion on Twitter and LinkedIn and everywhere. So what's your take on when you look at it as a prudent fund manager when you're analyzing a stock based on their profitability and the PE or the valuations they have been putting? From one lens that, and secondly from an investor perspective when he's now getting into such stock. So investor can be कि भाई हाँ सब ले रहे हैं because it got oversubscribed the one first day itself, if I'm not wrong. And but tomorrow if corrects post listing, say over next 3-4 months, 1 year, and he will be disillusioned. Investor will be disillusioned. So I want you to don both the hats. First, as a fund manager, when you look at it at the merit of it, what do you think about Lenskart?
So I will not comment on individual stocks, but if you go back to 2008, a market crash happened just after a large power company IPO, and people know which company I'm referring to. That also had the same craze. Everybody wanted to, jump into that power company's IPO as if there is no tomorrow, and they had no power plant on hand at that point of time. Everything was based on the drawing board. Eventually, it has gone into sort of liquidation now. So I think, as I said before, that fear of missing out, greed and fear, these are the things that people have to control. We didn't participate in the power IPO then, and we don't have a FOMO even now. So if we think that valuations are good, we invest. We have, we are not in any league table, or I don't have to prove to anybody that I have invested in some XYZ IPO. I mean, finally, you have to make money for, people, and and for investors. If that be the, the objective, there are many ways of doing it.
True.
As I said, I don't have FOMO. I sleep well. Whenever I get a chance, I go to the jungle and I am peaceful there. So it doesn't matter when the noise is too much, I run to the jungles.
So even the other day, just 2 days back, when the Lenskart was coming, so I was thinking about, so let me also make some video or a snippet or a reel on Lenskart. And when you see too much of it, why should I literally add on to the noise into the market? It literally doesn't matter adding one more noise into the market when you talk about it. But you rightly said, because that one of the power company you were referring to, at that time I was doing internship. I had been at my final year of my MBA in Pune. So we have heard the stories of people selling their land to buy that IPO कि भाई हमारी जैसे मदर कंपनी ने किस्मत बदल दी थी लोगों की, हमारी भी बदल जाएगी. And I had seen that happening. Today, with you on this and purely quantifiable, action-oriented macroeconomics, micros, funds, policy changes, interest rates, what we expect from the budget, how the market should pan out, Indian markets not performing, emerging markets playing their role, US contribution into the GDP and all. You had put so much of light into the things which many of the investors technically are not able to access the information because there is too much of aesthetic podcasts into the market where much of the essence, the weighted essence, does not reach to the investors. And with you today at our podcast, it has given us an opportunity to at least scrape that surface and let that knowledge come out of the depths of the earth to the investors to make a very prudent decision.
Thanks for inviting me.
Thank you so much, sir. And we highly appreciate your time today on the weekend. And have you a very happy weekend, sir.
Thank you very much.